Now, in the world of economics over the next 2 weeks, nothing much is due. Still, investors will eye the delayed U.S. GDP data set to release this week. While most market watchers will be focused on 2026, this week is likely to reignite the debate on U.S. growth versus elevated inflation. While not particularly market moving, the September quarter GDP report will be very interesting. The growth data was delayed due to the record longest U.S. government shutdown in October. A second consecutive 3% plus growth print will leave many people questioning why the Federal Reserve cut interest rates 3 times in 2025. The intrigue will be accentuated, especially with inflation up at 3% versus the Fed's 2% target. Also, unemployment remains low and equity markets trade near all-time highs. The Fed continues to argue that the cuts are being implemented from a risk management perspective. Monetary policy is still slightly restrictive. Analysts say with tariffs not being as impactful on inflation as feared and the jobs outlook looking more worrisome, moving the Fed funds target rate range closer to 3% makes sense. Now, in terms of the GDP report itself, the details will likely show that tech investment is a key driver of growth, and still consumer spending was held up by high-income households. The December quarter GDP growth is set to come in much closer to 1%, and that is in large part due to the disruption caused by government shutdown.